I think we are very close to a top. I get the feeling it wasn't really that big decline yesterday, but I'm looking for a Q1 correction in the S&P, but I think the S&P is up 10 to 12% 1 year from now. A trading range in Qs 2 and 3 and a rally in Q4. And keep in mind that November begins the 15-month midterm election year cycle rally. That is one of the strongest, and very few people talk about it. I don't know why. So that I feel confident about. And of course, the next 9 months, well, I don't know. It looks highly variable. I think oil is going to rally. Nobody in New York agreed with me when I was there in Q3. And foreign markets, I believe, will continue to extend their outperformance. And by the way, at the last slide, there's a free cycles report. If you go to cyclesresearch.substack.com, I have the Dow 30 stocks projection, one for each stock on a cycles basis, which you can get for free just by going there and punching in your email. So the 54-year cycle, I'll mention it one more time. Just deduct 54 years from where we are right now, which takes you to 72, a beginning of a period of price inflation, which we already have. Social unrest, we certainly have that. Rising interest rates. A declining stock market, well, not right away, and rising commodity markets. So auctions tell us that there is too much money. This comes under the heading in New York City in the 80s when the stock market started to boom, and especially in the 90s. There was a saying that cocaine is nature's way of telling you you have too much money. This is the auction market's way of telling us that there's too much money sloshing around in the economy. This is a ticket stub from Michael Jordan's first NBA game. It sold for $264,000 for a ticket stub. And this was a new record for Incredible Hulk #1 comic from '62. It sold for almost $500,000. And as we go to press, a rare copy of a comic book that introduced the world to Superman sold for $15 million for one comic book. Now, everyone out there is thinking of their mom and dad throwing out their old comic books, I'm sure. So there's lots of money sloshing around, but the narrow breadth is making it difficult for stock pickers. Only 25% of the stocks in the S&P 500 actually outperformed it last year, which means that only 29% of large cap money managers outperformed the market last year. You can see the numbers here have not been above 50 since 2007. So bubbles. People are asking me, we're in a bubble. Yeah, we are, but most bubbles burst in the autumn of years ending in 7 or 8. If you just do a distribution analysis over the last couple hundred years. And of course, in 71, Nixon closed the gold window. In 80, Carter signed the Monetary Control Act, which enabled the Fed to monetize any sort of paper. So what limits are there on what can be monetized? Theoretically, the Fed could inflate the currency to infinity, so there's no limit to the price increases, and there's no big mystery about gold being close to $5,000 an ounce. So let's go back to the stock market and take each of these markets in detail. There's a short-term cycle that runs into the last week of February. That's where we are now. And today, the market retraced more than 38.2% of its decline, not just of yesterday's decline, but of its decline from its recent high. So if you go over 38.2%, and this is at 50, that probably negates the decline from now on. And by the way, this is a repeating theme. Everyone should notice that whenever the market declines, the number of advances over decliners has been startling, as well as new highs over new lows. And that's even on big down days. So, and I'll have more to say about that. There will be a Q1 correction, likely starting in February. I think it's the first week in February. Qs 2 and 3 are in a trading range. Q4 in any year has been bullish, and it's the start of the 15-month midterm election year cycle. Now, this is obviously the Dow, and it has retraced part of that decline today. So we're up somewhere in here, but we've retraced more than 38.2% of that 3-day decline, which indicates that it is probably over and going higher for now. Probably not tomorrow, but into the end of the week and into February. And here you see the different retracement levels. And notice we've got two of the retracement levels overlap right here. So on the downside, I think the most you would see is 6150, which still would be quite startling from these heights that we're at. Election years +2 in the DJIA from 1885. This is 139 years worth of data. Blue, well, let's start with red, is the probability of a rise on that day. So the probability of a rise, or I should say in that month, in January is the right-hand scale. That's 60%. So here you see in December, it is about 68%. The blue vertical column is the average percentage price change, and the green is the expected return, or the product of that number times that number. So this is what it looks like in election years, 2 years past an election. And as you can see, February is weak. You can see May, June are not very strong. September is very weak. October is not too strong. Now, all years ending in 6, of which we have only 13 to 14. Once again, February is weak. April tends to be weak. You notice Q2 tends to be weak. Then 3 tends to be up. Then up in the first 2 months, down in the third month, and then a strong Q4. Let's put the two together. Histogram of monthly expected return in 2026, all years ending in 6 that have also been election years +2. So same theme. January, very strong. February, weak. March, blah, flat. April, May, and you can see September is then very weak, but Q4 is relatively strong. December, unusually weak. But that's my blueprint for the year. And here's the usual 1-4 10-year cycles. I'll go through them quickly since I think you probably already know about them. The 1-year cycle is the regular average cycle in any year. The usual September weakness is right here. The 4-year cycle is, again, that's what's called the election year cycle, except that, as my old friend Ian Notley used to point out, that there's a 4-year election cycle before the Federal Reserve existed in 1913. There's a 4-year election cycle in countries where there's a 6-year electoral cycle, 8 years or no elections whatsoever. In other words, there's a 4-year cycle, period. The 10-year cycle is Edgar Lawrence Smith's decennial pattern, and you can see that is not strong. So let's put them all together. And that's what it looks like. I don't think the market's going to be that weak. I think this is contributing toward this Q1 weakness. I see that in here. The dynamic cycle, I forgot to put in here, but it looks the same. The dynamic cycle is drawn directly from the most recent data. And yes, it does decline into April. So it matches this, and that's one of my primary forecasting tools. These 1, 4, and 10-year cycle, which are static cycles and that they don't change, and the dynamic cycle, which does change. It absorbs, it takes in new data every day. So that is the 1, 4, 10-year cycle. That's that cycle, but only for Q1. You can see it a little bit better. So I think we're on the verge of this right now. But 2026 sets up a conflict. The periods 2 years after the election, week, years ending in 6 have been about average. There have been 7 such conflicting years since 1885. 4 of 7 have closed substantially higher. 1 was down slightly. The average is 0%. It's 1886 plus 4.3, then down 2, up 34 basis points, down 8, down 19, up 23, and up 16. If you average that out, it comes out to about 0, maybe 1%. The modifiers, these are effects that alter the cycle projections. The waves remain the same, but the amplitude is modified. So modifier number 1, share of clients expecting the U.S. to be the best performing global equity region at the Goldman Sachs Global Strategy Conference in January of each year. And here you are. This was 2025, and I do not have the most recent ones, but I think there was too much optimism at this point. Now, something I've noticed over the years, institutions set up for the coming years, beginning in November, around Thanksgiving time. The effect appeared after 1915. Prior to that, I don't think the institutions had the purchasing power to make this occur. But the performance from November to January is pretty key because that's when the institutions do all of their buying. And last year, this gave a moderate signal. This it was really not very strong, but 2025 was a year ending in five, and as you saw in the last presentation I did, it could be up 30%, but it was only up about 16. I think the reason for that was because of the weak November to January performance. So 2026, we have a strong November, January, except for yesterday. So it's still not resolved, but keep in mind, as I keep pointing out, because I think most people don't know about that cycle from the midterm. But right now, what we have is the 1, 4, and 10-year cycle projecting, or I should say, the combination of cycles project 1%, and I would say it's about 15 to 20% is projected by the cycle created at the end of the year. When you average that out, you come to about 10 to 12%. So that is my target 1 year from now. And this, I think, is most important if you're a fund manager. Technology leadership will moderate. That already began last year. I'll show you from the previous conferences. I think healthcare and base materials will be stronger. They have certainly been laggards. Energy will rise in the relative rankings. I'll go over that. And the emerging markets will continue to extend outperformance over the USA. Now, first, here's the emerging markets, the only slide I'm going to show you, but look at the relative strength. That's price, momentum, relative strength. This is weeks, this is months. And if you draw a trend line down here, you're breaking this downtrend. And cycles that I'm not showing you right now reflect this. General rule of thumb. When the market is coming down like this and it is breaking a downtrend that is about, let's see, it's 2011, 2025, that is about 15 years, multiply that by 0.6, and that's how many years of outperformance you can expect. So you're looking at 5, 6 years or so. It's the same thing if I use the MSCI Global Index without the USA. Here are the sectors. This is a special RSV is relative strength valuation, a special relative strength measurement device or technique, I should say. Healthcare is number one, materials number two. They were at 1 and 2 back in December when I said I thought healthcare and materials would rally. Technology has slipped to 3. I suspect it will go a little bit lower, and I expect energy to rise. So that's the current relative strength. This confirms the thought that money is flowing out of technology into healthcare, materials, and energy. And here's the current S&P 100 relative strength screen. Here we have Intel, we have the 2 alphabets. Go down the list. There's not another Mag 7 stock in here. There's not even another technology. Well, maybe Thermo Fisher is technology, but notice you have banks, you have industrial stocks. There's Halliburton, one energy stock. I expect financials will do pretty well. Defense stock. So this is confirming what I think this is going to continue. I think Intel was up pretty big today. They're coming out of a very, very long decline, so it is not surprising that Intel is holding up here. Here's the Mag 7. This is on the same basis, but I've just isolated them. 97.5 is always going to be the benchmark, the S&P 500. Google is at the top, Tesla second, Amazon third, Apple, well, Nvidia is about equal to the index. Apple is below the index, Microsoft below, Metastock below, and Metastock broke to a new relative low just recently. So I do not think Metastock is a meta stock. I'm thinking of the software program. I don't think, they should have left the name as Facebook. I don't think that's going to improve. Microsoft does show a strong close to the year, so I think Microsoft will rise in the relative rankings at the end of the year. So here are the stock picks from last January. Those are the longs that I recommended on the left and the shorts on the right. The only one that was outrageously wrong was Nordson, which was a short that jumped 15%, but you could see it did pretty well based on relative strength and cycles. Now, this is from last January. I thought Nvidia would be down. Look at the cycle. Look at look at the price coming down to meet the cycle, and there's a buy in late April. So on top of this, a contrary opinion sell signal. This is from November 18th, 2024, Barron's, The Nvidia Way, a complimentary tribute to Nvidia right on the front page. That's a negative. How it worked out. Here was about the time we had the conference was here in January, and you can see the low in April. It was early April rather than later April. So let's take a new look. Here is an NVDA contrary opinion signal 2025. Person of the year is the founder and chief executive of NVIDIA. He's on the cover of the Financial Times, and this is very recent, of course. So that's negative number one. And now here are two more contrary opinion signals. The cover of Time, Person of the Year, the architects of AI, and AI, the technology. Not a positive signal. And here is the current NVIDIA cycle. And you'll notice it is down into March, which is about the same time I'm expecting the market to bottom, later March, early April. So here we have one more. I think we have, oh, there's the contrary opinion signal right there, specifically for that stock. And on AI, I would just like to say that this is something I started following. My boss sent me to an AI conference in 1983. And I sat next to a guy and I said, hello. And I introduced myself. And he said, I said, what do you do? He said, I'm an AI expert. Really? Is there any existing AI right now? He said, no. So when you say AI, I think people have the impression of Captain Kirk going to the galley of the Enterprise and saying chicken salad sandwich. And there's a bubbly noise and a door goes up and there's the sandwich. We're very far from that. But my friend out in Silicon Valley, Victor Verpaillet, serial entrepreneur, as he describes himself, says that is going to happen in the future. It's just not here yet. So I think people's expectations for AI are way over the reality right now. So that might be the fundamental reason for a sell-off, but that's NVIDIA pointing down. And so contrary opinion. Now, as far as I'm concerned, the godfather of contrary opinion was my late friend, Paul McRae Montgomery of Legg Mason Wood down in Virginia. He researched 3,200 covers of Time magazine and found when there was an investment related story on the cover that the odds were 80% that within 4 months that investment would go in the opposite direction to that which the cover suggested. The effect was very magnified if the story appeared on the cover of a non-financial magazine, because let's face it, Barron's and The Economist, they have to have financial news on the cover, but if it's People magazine or it's the front page of the New York Post or something like that, the effect is even greater. So this was from last April. I presented this in June. Here you have 3 economist covers, all suggesting great instability. Here's a dollar crisis, the age of chaos, and ruination day. And here's one more. Barron's, May 6th, that's May 5th, 2026. Where did the bulls go? Well, as we know, the low was April 7th. So this is contrary opinion at its best. Now, notes right now, if you are thinking of buying the US 10-year note, you are swimming upstream, you're walking up the down escalator, and you are eating soup with a fork because you're going against the tide. This is the histogram of expected return, 42 years worth of data, and you'll see January is strong, but notes haven't even been strong in January. They're rallying today, but they got clobbered before that. And March is the single most bearish month. So Q1, I would not want to own a note. From February 1 to April 2, notes have risen only 36% of the time. So that's all I'm going to say about notes. Now, what I call cycles research, if I put the dynamic cycle on top of this, and they both point in the same direction down in Q1, that's the best type of signal you can get. If they both pointed down, that 36 would decline to about 20, 25%, which is very good odds. 3 and 4, 4 to 5. If the problem comes when they conflict, in which cases you mostly get a trading range, with the dynamic cycle being stronger than the notes. So Bitcoin, I've gotten quite a few hits on LinkedIn for this. Bitcoin has been following its cycle really well, as you can see, and if it continues to be correct, we're having a rally up into April, in which I think we'd probably get back at least to 110 to 115. So I'm very surprised because I only have 10 or 12 years worth of data. I really did not expect Bitcoin to follow its cycle very well in the first few attempts, which were 2 years ago, did not work out well. It's only recently I started to follow this. Now, here's the one I really like. This is from the June conference. I think I said last January in this conference, I think I said oil would be down all year, but I know I said it in June because I found this slide. And you'll note if we go to the beginning of the year over here, 2024, we're coming down, January 2025, we come down further, and it shows a low in the first quarter of 2026, which is what I said in June. So here's the seasonality. Note that over 41 years, January, February, March, April, so April, May is usually the high for the year. And of course, October and November are the Bermuda Triangle or Death Valley for oil prices. There's not much you can tell to an oil bull in October and November. It's just it's very heavily weighted toward the downside. Now, from February 21 through May 21, prices increased 76.2% of the time for a 5.2% gain. That's using this alone, the static cycle. That's not even including the dynamic cycle. When the two of them agree, this number here will increase by 10 to 15%. So it'll go to sort of 83, 85%. So let's take a look where we stand now. This is great volatility, as you probably know, and it indicates that this volatility is going to continue, but in an uptrend up into maybe June. So this cycle, static cycles, agree with the dynamic cycle. Now, what you do then is you go back to plain vanilla technical analysis and look for a confirmation, and that's not it. There it is. Sorry, it's out of place. A downtrend has been broken. And I said that I didn't think 50 or 55 would be broken. Now I'll go back and show you why. Here we have the 61.8% retracement of the entire move from 86 up to the high in 07. 61.8%. It's right there at about 58. And there's another support level I'm not showing you here at 50. And look at the sentiment. It's very bearish. Bearish oil wagers rise to highest on record. Look at that. And this is since 2011. This is from the Intercontinental Commodity Exchange. So if you just showed me the support at 50, 55 in this graph, I'd be bullish. But we also have the cycle, which I've already shown you. And by the way, this is monthly oil from 1880. This is data dug up by the late Ian Notley of the Notley Information Service. This is the wellhead price of oil. It goes all the way back to 1880. It is monthly. And here you can see it is at price closed at 55 and 55. We have to look at the blue numbers here. Blue numbers, green lines. It is right at a 50% retracement level of this entire move from here up to here. So we've got support, we've got bearish sentiment, we've got cycles turning up. This looks like the perfect witch's brew for higher prices. And what I like is it's unexpected. And I think few people realize that money has to go somewhere. It is fungible. It goes all over the place. It's like stepping on taking a very large balloon and squeezing it at one end, it just bulges at the other end. I think a lot of that money that's coming out of elevated high-tech big cap stocks like the Mag 7 is going into energy, as it will go into basic materials and into healthcare. So energy stocks, this is the plain vanilla analysis that we used to do back in the 80s and 90s using the Notley system. This is a 3-up chart, daily, weekly, monthly, closing price, momentum, and relative strength. And I pay great attention to relative strength at all times. Here you see the relative strength downtrend is broken here. And you'll notice in absolute price, it's broken a little later. These moves frequently show up in relative price before they show up in absolute price. Now, classic Ian Notley buy signals, higher lows in momentum, flat relative strength. Here, weekly, this price trend has been broken to the upside. This is Schlumberger. This is a stock that I bought a week or two ago. And I picked it by running the relative strength screen on the energy stocks, and I come up with SLB and XOM. Let's look at XOM, Exxon. Now, this is a little less relative strength than I'd like to see. You can see down here, it's just starting to break through that downtrend line, and you see a higher low in relative strength monthly. And here you see the classic Ian Notley, higher lows in momentum. And here you see a double low in monthly momentum. And that, I should have blown this up to show you a bigger picture, but visualize that it's a big rectangle. It's broken out to the upside. Well, that rectangle is about 20 points high, which means this stock is probably going up to 140, 150 area because it is broken out of a big rectangle, which is the most reliable of all technical signals. It was proven so and published in the Financial Analyst Journal. I should do a presentation on that someday. Now, 1 year ago, I was pounding the table on gold because this is what the cycle looked like. And down here, you can see the length in days of the cycle. It's 81, 120, 63, 86, 109. But the point is, it pointed to a strong year in 2025. Here is the cycle now. It is up at a high, and I think we're either topping sometime this month, no later than August 20th, which February 20th. August would give us a lot of leeway, wouldn't it? So it's either here or it's over here. That would be February 20th, not August. So, and as far as I can say, gold has overshot my objectives of, well, I think it was 4,500, and it's well over that to 4,700. So now here's the gold seasonal period. Are we in the weak time of the year? Yes. Right here, you can see January strong, February flat, March is the weakest month in any year. This is the horoscope of expected return, after which you get a pretty good rally through the rest of the year. August and actually September has been stronger than that recently, but traditionally there's a very good June to August run, and don't ask why, but October 15th to October 31st, it's again Death Valley for oil and for gold. They usually sell off pretty sharply in the second half of October. Now, here's the secret gold sentiment indicator. There was the very bullish sentiment back here at the 2011 high. And this is a Grandmaster formula that I got off of the Great Pyramid at Cheops during the spring equinox during an eclipse while listening to Led Zeppelin records played sideways. And you see it coming to a top here. So what is this? It is the UGL divided by the GLD. The UGL is the multiplier, the leveraged gold index. For every 1% gold goes up, UGL goes up 2%. The GLD is for the less adventuresome, it goes up 1%, it moves with gold, 1% for every 1% move in gold. So let's buy some gold. Okay, we're buying gold in here. Well, we have to buy gold, but I'm not that optimistic on it. So we're going to buy the GLD. So the ratio falls and falls and falls, finally hits a low. Well, maybe we've been a bit too conservative. Maybe we should buy the UGL and get some leverage on our gold trade, and you can see what's happening. So we're approaching the red line here. So I don't think gold can go up much more. I don't have a specific number count since my number counts have been blown away. My last one was 45.50. So that is the gold sentiment measure, and you can do this with any ETFs. Divide the leveraged by the unleveraged. They're good sentiment indicators. Now, special offer from Cycles Research. Receive the most recent monthly stock cycle graphs for the Dow 30 stocks. Free Cycles report, cyclesresearch.substack.com. Cyclesresearch.substack.com. Just punch in your email and you're automatically going to get the report, which begins with triple M, which is right here. So, Richard, do you have any questions?
Hello, Bill. Thank you. Yes, I have lots of questions.
Okay.
Um, and thank you, as always, for your excellent research. Would you go to your first slide now? Back the right here, just kind of revisiting your
Yeah.
market summary now that we've seen all your research. So a Q1 correction in the S&P. So that's the you're expecting that, by mid-February, right?
No, by late January, early February. First
Late
week in
Jan,
February,
oh,
I think
first
is
week in
very bearish.
February.
Yeah.
Okay. And the S&P up 10 to 12% in 2026. Okay.
One year from now, yes.
Yes, but weakness in the first quarter overall, sideways or trading range in Q2 and Q3,
Yeah, and let me
and
just
rally in Q4.
explain Q2, Q3. I think there's going to be a lot of switching from as I said, the big cap stocks, particularly technology, into energy, base materials, healthcare. And if you look at the market on down, it's been remarkable. We had a big down day a couple of weeks ago. If I would have put up the slide of the advances, declines, new highs, new lows on that day, you would swear that the market went up, but it went down. It's very few stocks that are heavily institutionally held. They've, call it but overbought, technically overvalued fundamentally, can't go much higher. The air is starting to come out of them. And as they
Mm-hmm.
go down, they drag the indices down, but the stocks that are coming up can't really offset, are not equal to their weight in the indices. So as they go down, the other stocks go up, the index is dragged down, but a lot of stocks are rallying. It's amazing. Storage, now here I go again. Seagate, STX. When the market came down yesterday, STX hardly moved, and the
Do
stock
you
has already tripled
do
since
you think
last
this is the
April.
long-awaited, rotation and broadening of the rally out of the Mag 7 into
Oh yeah, it
Russell
started in
stocks?
yeah, Q1. I called that last year. I said, according to all my work, technology is going to lead in 2025. But I said these stocks, I said they just can't. The Mag 7, my analysis in each of those said they can't go any higher. So if technology is going to go higher without them, it's got to be other technology stocks picking up the slack. And
Okay.
look what the like Intel is back from the dead. Micron was way up last year. Look at the chip
Hmm.
stocks.
Hmm. Yep. And so it seems like you see a similar, well, you're less bullish on technology overall this year.
I'm bullish on selected technology stocks that are not the Mag 7.
Gotcha. But you're more bullish on energy, healthcare, and materials,
Yes.
and particularly on oil.
Yeah, well, oil, I've always done pretty well with energy, and if you uh, if you keep a close eye, they tend to follow their technical signals and their cycles. I mean, number one, they're related to the price of oil. So if you've got a good, solid, reliable oil cycle,
Hmm.
that's 51% of the game right there. Then after
Right.
that, you can look at the industry, whatever you can look at the S&P industry groups or the XLE ETF, and then look at the stocks in the ETF with the stocks in the S&P groups and start picking from there, but start with the ones with the strongest relative strength first.
Gotcha. Yep. Okay. And then you have this measure called the RSV,
Yeah.
and it seems to be different than the RSI.
Well, RSI is a technical indicator. I'm talking about relative strength, the strength of the stocks or the weakness versus the indices, which is what all
Okay.
funds are measured on that. And it is so important. It is so important, Richard. I got a BS and MBA. I waived the first year of the master's program, got my master's degree in 11 months, and relative strength was discussed. I kept a record for a grand total of 30 minutes. So you wonder why those funds are underperforming? People concentrate too much on earnings and absolute price. Have to look at relative price,
Relative to its benchmark.
obviously. Yeah,
Yeah. And then so the typical relative strength as a technical indicator, in on these platforms is more about momentum.
it's an momentum oscillator, but I'm talking about relative strength. And just let me say that's the most important. That's how you get measured. And
Right.
about a third of the about a third of the funds are outperforming the market. I'm not surprised at all. When I got to ADIA, 58% of the market cap in a $6.2 billion portfolio had negative relative strength for 6 months. When I get to the new guy and I point this out immediately, which made me Mr. Unpopular for the next 13 years. Um, but you have to have my rule of thumb is if a stock doesn't make a new relative low after 6 months, it has put in a base. And I talked to Richard Bernstein at Merrill Lynch when I visited them from ADIA. And I said, Richard, is it 6 months or it's 12? He says, our tests show 6 or 12 doesn't matter. I said, oh, good, I'm going to take 6. And if a stock makes a new low, on average, that means if it makes a new low today, that means you've got 6 months for it to build a base. So you're looking at you look at the stock again in July. And if it hasn't made another relative low, then you can consider it for purchase. But I see people buying, stocks with weak relative strength based on positive fundamentals. And my question is always in these meetings, which I fortunately no longer have to take or sit through, um, I say, well, what makes you think the relative uptrend is going to turn up? And if you're right or wrong, why is it that everybody else on Wall Street disagrees with your rosy fundamental analysis of this company? Because obviously they're selling.
Hmm. And so I'm interested, is this all purely technical or do you see geopolitical significance to what your forecasts are?
Well, I factored that in, and before I wrote the bullish energy piece, I pointed out that the countries that were in the, I don't want to use the word crosshairs, we're not shooting at them, but under scrutiny, we'll say, from the United States were Venezuela, Iran, and Nigeria, all big oil producers. And if you're intercepting oil tankers at sea, that to me is that's a bullish external signal. So I think the
Right.
exogenous influences are all on the side of oil. And if you remember a year ago, I said, well, why would oil come down all year long? Well, because you've got a new administration that's business friendly that is going to drill, baby, drill. So
Right.
that plus when I met with my old friend, first guy whose hand I shook at ADIA when I moved in, I did not know he was going to become so powerful. I wouldn't have let go of that hand. And anyway, he became minister of the entire economy. And I said to him, well, what are your two concerns? And he said, fracking in Iran. Fracking was more important to them than Iran.
Mm. So what do I know you also study cycles of war. So do you
Yeah,
see conflict? Could that be the source of rising oil prices?
I think you're not going to see any conflict break out, I think, until next year or the year after. Remember, most panics occur in the autumn of years ending in 7 or 8. So I don't think it's this year.
Okay.
And whatever the cause would be, right now, I've been talking about a civil war for several years. Right now, we have red states and blue states. Russia had white states and red states. And now you've got the governor of Minnesota saying he's going to call out the National Guard and the federal government saying they're going to send in the army. It sounds like the first battle of Bull Run. So,
Yeah.
and I don't think I discussed this with a friend of mine who thinks it will happen. I said, well, it's not going to be like a Mason-Dixon line that you can't cross, but
Hmm.
it's going to be pockets of resistance and violence in different areas of the country.
Hmm. Okay. Um, Couple more questions. At the beginning, you used the 54 years. You talked about,
Yeah,
2026 minus 54. Why
yes.
did you do that?
Well, the Saros cycle is a cycle of eclipses. It's about 1,300 years long. There are about 70 eclipses in any cycle. They're spaced 18.2 years apart. And every third one is very important. It tends to
Mm,
return, like if, do you remember all the unrest in the Middle East where the governments in North Africa fell a few years ago? If you go back 54 years, there was the Suez Crisis. So if you just knew that, you would look at the current situation and say to yourself, what looks and look for the instability. And of course, it's always great when you can call people and talk to them, since I can't read any of the local newspapers.
hmm.
But if you go back when you can also multiply 54 by 3 or 2, and the Crimean War occurred 161 years before Putin seized the Crimea. So that's just 1 year off the 3 times 54, which would be 162.
Hmm. And the 18.2, is that related to the real estate cycle at all? And do you see
I think
anything
it
in the
is.
real estate cycle
Yeah,
yourself? Or
well,
do you
I
study that?
know. Yeah, I've got the book right here. Is it The Secret Life of Real Estate and Banking or The Secret Life of Banking and Real Estate?
Hmm.
That's an excellent book that everybody should read.
Hmm.
And yeah, I agree with that, but we might be off a little 1 or 2 years. I thought the real estate had already peaked. And I think you have to remember that 2007, 2008, there was another cycle. There's a credit cycle that's about 36 years long that was used by Harriet Higginson, whom I was told in the 30s was making 35 grand a year trading stocks. And if you met her, even I met her in 1980 at a SIRE meeting in New York, and even then she was a real firecracker. And she was 60s or 70s. She lived to be 90, I think.
Hmm.
And
The credit cycle.
yeah, the she used the credit cycle, which she said was 36, 38 years long. Well, just like people, some year men like to wear brown, other years men like to wear black. We like strawberry, we like vanilla. People
Hmm.
will take on credit very readily at certain points in the cycle, but not in other points of the cycle. They just
Hmm.
feel it's too risky or whatever. That
Right.
cycle and the real estate cycle both peaked, and that's why you had such a wicked correction in '07, '08. That's not the case right now.
Hmm.
So I
Okay.
think, I mean, from what I'm hearing, it's just prices are too high and sellers are holding their prices there and people can't meet, they refuse to meet that price.
I think partly because they're locked into low interest rates from
Yep.
when the Fed was artificially suppressing rates. Okay, good. Well, a few more questions just from the audience here, and we'll wrap things up. Um, Mastering geo predictions, great content as emerging markets might outperform. Do you see a weak USD in 2026 and for several years?
No, I don't, because I've lived overseas, well, since 1990. And whenever things get very chancy in the world, the world becomes relatively unstable. Everyone sends their money to the US.
I know that, and when, if there is going to be a debt crisis, you got to pay back all the debt in dollars, right? So
I don't think
you're going
that
to need
debt
to get
will
the
ever be
dollars to
paid back.
pay down the debt. What's that?
I don't think that debt will ever be paid back.
Yeah. Ben wants to know if you'll be presenting at the in New York City in May.
Yes.
Yes, indeed. Looking forward to that. And you spoke about the 54-year cycle, take us back to 1972, a period of higher inflation and the market moving down into the end of 1974, and commodities rallying. Do you expect a repeat?
I'm expecting, well, as I said, a okay year this year, but most panics occur in years ending in seven.
Hmm.
And I also believe fighting will break out in 97, 98. Now, what am I saying? We are in 27, 28. I think that, civil disobedience and um, I think there's a good trade to be done in selling self-defense, whatever that might be. And
Hmm.
you've seen a stock that's done well is Byrna, Byrna. It's the pistol fires a projectile. That when it hits the target, it explodes with some sort of incapacitating gas, like pepper or whatever.
Hmm.
Um, that stock I've done well with,
Hmm.
and of course we've got what used to be known as Taser, which is now Axon, Axon. They've
Hmm.
branched out into drones. And oh, I almost forgot to tell you, my chief programmer here in Austria, who did most of my work,
Hmm.
super busy now because the company he's with landed the contract to do drone air traffic control. And they showed me the number of drones they expect to be in the sky within 3 to 5 years.
Hmm.
And so to make sure nobody runs into anybody else, I've seen it operate for Austria. It's sold to entire countries. Now I can't pay him enough to bring him back to work on my cycles program, but there's a map of Austria like this, and over to the right there's a little red rectangle. I knew what it was because a friend of mine runs it. It's the only facility that has nuclear material. It's not a nuclear reactor. They just have
Hmm.
nuclear material. You can't fly anywhere near that. And in Lower Austria, where there's a lower population density, you can fly anywhere. In Upper Austria, you have to fly. He showed me, he filed a flight path. I want to send my
Hmm.
drone from this address in Vienna over to here. And within seconds, he got an answer. It's all clear. So they sold this to seven countries with three more on tap. And here's what I predicted. I had this discussion with Jim Dunnigan, NBC's former military commentator, the guy who ran Simulations Publications Incorporated, where I worked as a student in the 60s, 70s. And I said, Jim, do you remember spotter planes in World War One? They used to, biplanes would fly over the trenches and the pilots would wave at each other. Then 45 caliber guns shoot at each other. Then they started dropping bombs. I said, the same thing will happen with drones. And then the planes got more and more sophisticated. So I told my friends at doing the drone air traffic control, you're going to do a big business. You're going to have to put in electronic countermeasures like Sanders Associate used to do, Loral, E-Systems, way back. All these companies were acquired. And sure enough, he just told me 1 month ago, the countries they've sold the drones to, or there's so many incursions by Russian drones here in Europe that they want electronic countermeasures in each drone, which is very high margin business because they have to create it.
Wow.
So they're doing a bit. So I think there's a big business in drones, in
Hmm.
self-defense, security. And in fact, this company was acquired and they went into security. They did all the coding for the Miami and Chicago police departments. So I think that there's a lot of growth there.
Growth in conflict.
Yes,
Very good. Last question. I'm just
sure.
curious, like when you do a cycle chart like Nvidia, it looks like a dynamic cycle. Is that a
It is.
similar 1, 4, 10 year thing, or how are you
No,
constructing those dynamic
it's
cycles on
it's
it?
just it's extracted directly from it takes deducts 1 year. It doesn't use the let's say the data starts in 1980. It will take 1980 to 2024 as being, well, now 25 as being in sample, or to 2024 as being
Mhm.
in sample, and the next year as being out of sample. And
Mm.
it projects the most recent and profitable cycles out into the future. And again, if you uh, send your email address into the Substack address for Cycles Research, you'll get that very study for the Dow.
Okay, great. Cyclesresearch.substack.com.
That's it.
So make sure you go there to get your free report from Bill, folks. And Bill, thank you so much.
Sure.
Fantastic as always. And we're really looking forward to seeing you in New York City. It's going to be a
I'm looking
blast.
forward to New York City too. Yes.
And I would like to get you on to talk about the rectangle breakout.
That's a date. Yeah, we'll do that.
Okay, awesome. All right, thanks again, Bill.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
Foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.